we should start the year looking back at what was 2022, and I think 2022 was a very difficult time for stock markets in general. I mean, we had the unfortunate incidents of the war in Ukraine, which pushed oil prices up. It sparked worldwide inflation. We saw aggressive interest rate hikes around the world. China was locking down because of COVID again with their zero COVID policy, but they are slowly opening up. To recap a bit, the top 40 in South Africa was up 8%, but that was mostly due to the late run at the end of the year. The ZAR was weaker by 7%, the S&P was off by 7%, and a stock like Tesla was down 66%. So yeah, 2022 was largely a mining and a bank story, with gold up 7%, stocks like Thungela up 202%, Standard Bank, Nedbank, Absa, all up in the 20s, with Naspers up 20%, pushed largely by Tencent, almost doubling since October. And then you got stocks like Anglo, FirstRand flat, a couple of the stocks that we actually like, and a couple of stocks that we own. MTN, Spar, Sasol, all down slightly. Even stocks which we get lots of questions for, like Renergen, was also down 37%. Looking forward at 2023, I think if we can avoid a black swan, or should I say a black Eskom incident, everybody's talking about the possibility of having a complete meltdown because of all the load shedding going around. If we can avoid that, I think 2023 will, on balance, be a good year. I think the oil prices will slowly rise towards the second half of the year, as Europe has had a very warm winter this time around, but and the US have been liquidating their reserves. But the moment they stop that, I think the demand will return, and I think all in all, it could be kind of a bullish year. But I'll ask you a question about that later. In the meantime, I'm going to ask Vaughan to bring up his presentation and then take it from there. You ready, Vaughan?
Yes, I am. Morning, everyone. Let me just share my screen. Okay, as usual, I'm going to not do the best, the most perfect criteria in terms of presentations. I'm going to keep the slide up so I can actually read what I'm talking about. I've got about 5 or 6 slides that I'm going to share of a presentation that we do on the year ahead. I won't go into the details, but I'll just give the highlights of what we're thinking. Remember, from the position of the people on this call, you've got to understand that our positioning is related to a portfolio. So we are never going to be advocating the wildest, smallest, most volatile stocks, because we always take risk into account when we talk about some of the opportunities that we see, because it's in a portfolio context. So that just sort of gives you a bit of an idea of how we think of the world. So let me move on to what we're going to think about. I'm just going to touch on the headlines. I'm not going to go through the detail. If you look historically, in this hiking cycle, everyone's probably seen an incredible amount of what happens when the Fed stop hiking. Will they continue to hike? Is inflation going up or down? We just have a quick look in history, and I won't show you the charts, but the reality of it is that we think the mid-70s and the early 80s are probably the most similar approach to what we're getting now, which is sort of high inflation and central banks that get quite aggressive. What typically happens historically, doesn't necessarily mean this time, but historically, is that the Fed needs to stop hiking and start cutting before the market actually starts to recover. Now, clearly, the market discounts ahead. So as you can see with the rally that we've seen, the market is trying to work out whether they are going to be cutting within the next year, as it discounts the year ahead. The second area I'm just going to show a chart or two is total social financing for China. And why do we care? It's because just under 40% of our index is resource stocks. And front of everyone's mind is the reopening trade. We are slightly less optimistic about that, and I'll show you why. And that thinking feeds into obviously sector positioning and then stock positioning. Then we'll show you 1 or 2 slides on valuations. Shouldn't be rocket science, but it'll go through quite quickly. So if we jump over to the, let's start with market corrections, which is in this chart, and we're looking at the 70s and 80s. It's a complicated chart, but really what you're trying to take away from it is these vertical orange lines. The blue is the S&P 500, the green is the earnings of the 500, and the red is the Fed funds rate. What you can see visually, typically you need to start cutting before you bottom. That's just a sort of a key takeaway. That's the first point that we want to make. The second point we want to make is that everyone talks about valuations being very attractive and that the US S&P 500 valuations are in line. Now remember, if we're simplistic and we look at a PE, so price divided by earnings, you need your earnings to be in line for that PE, the average PE that we're seeing now, to be okay. If you look across this chart of the black line, you can see trend earnings for the S&P 500. We are well above trend. So if you normalize the earnings to trend, the PE isn't so cheap anymore. So that's a key takeaway. We aren't as cheap as it optically seen. That's for the S&P 500. Moving on to South Africa, same kind of chart, except I want you to focus on the green line. So the black line is the Aussie and the gray line is the trend. So the Aussie, again, like the S&P 500, the trend with earnings are well above trend. And why is it well above trend? Because of this green line, which is commodity earnings. So two things jump out at me, and I hope at you. Number one, they're incredibly volatile. So if you go back to sort of 2012, and if you look at the earnings for the Aussie, and what you see in the next 3 years, they basically drop by 75%. So if you're a commodity bull and a resource bull in South Africa, you better hope that we are not about to see a historical opportunity where the earnings drops that fast. We are nervous given the level of the earnings. So that's one to take away. Then remember I said I was going to talk about what's driving it is total social financing. Sorry, I'm tripping over my own words here. All this chart shows you, don't worry about going into the details. It shows this is a rolling 12-month average of the total social financing. For those of you that have been following China for quite a while, you'll know that social financing is about 60% debt. It's a whole lot of equity and it's basically government flows. And generally speaking, simplistically, if there's a whole lot of debt being thrown at the market, people need to do something with it, and they tend to invest in property in the Chinese market. You can see the growth rate each time going back to 2008, the growth rate is lower and less aggressive, obviously, as China becomes bigger. So your problem is you need to throw an incredible amount of money to get the same kind of impact that you got at the past. Obviously, that's what makes us a bit nervous. So having said that, what's our positioning? Globally, we still overweight financials. Remember, you have got very nice interest margins and you've got decent growth, even though the globe is slowing. Energy, for the obvious reasons that we know now, even though it's becoming a lot more mature. Healthcare, because we're a bit more defensive. You can see in the red on the underweights, we don't like the materials for the reasons that we've given above. A, slowing growth. B, we don't think the China reopening has got a lot more fundamental support. Property prices, etc., etc. At the moment, it's all about price, and it's all about investors thinking there's going to be fundamental support. So you've got to take your view on that. In South Africa, we're overweight financials, primarily to bring it back to Sarel's point. If you look at financials, commercial or corporate loans are about half of their loan book, and that loan book is growing at about 15% plus, primarily because everyone's trying to get off grid and borrowing money to put solar on. So that's got a few more years legs, which is a nice thematic driver. The resources we underweight. So I'll just jump onto 3 slides or 2 slides. Those ones I'll end. Remember, as I said at the outset, we think like a portfolio. So what is big in the portfolios? What's big in the index? Financials. You can see the red line across is benchmark weight. So what's big in our market? Financials, materials, and consumer discretionary, which is the famous NASPAs. So you can see our positioning is we like financials, and I'll come to the stocks. We are sort of neutral on materials, but you remember I said we don't really like them because we're very overweight Sasol, which is essentially oil, and we're underweight some of the others, but we are very, very careful not to be too underweight because, as we've all seen, the momentum is incredibly strong. And then we are underweight consumer discretionary, which is underweight NASPAs. So for those of you, if you look at our portfolio, this is the portfolio. Here's the picks. We like Absa. We like Sasol. We like Enizo. Nice defensive, solid grower. Mr. Price for the South African context, because you've already got a bank. And then the Anglos and the Sibanye is because you can't be too underweight resources given how big it is. But as we say, we are nervous and we are watching that very closely. We prefer the Sibanye, but we do have Anglos at the moment and we're watching that closely for the obvious reasons we said. I think I'll leave it there.
Thanks a lot, Vaughan. It's interesting. And just for the audience sake, Vaughan and I are not colluding here, because I told him yesterday, I said to him, look, man, I think we have to pick 5 stocks that we're going to be looking at throughout the year. And I picked my own, and we do have some sort of an overlap. On my list, I see I had first ran in favor of Absa because of the commercial loans, as you've explained. I still have MTN in there because I think the Ghana taxing will be shrugged off, and I think the potential's there for that stock to return to much higher levels. I have a slightly different view than you on the Chinese economy, and I think if that thing starts opening up, something like SDX CHN, the Satrix China ETF, may actually be worth a punt. Obviously, we don't carry that in our portfolios, but I mean, it's something to be looked at. I also have Sasol, and then instead of opting for a minor, because I'm also very, very scared of the high commodity prices, I opted for Shoprite, which is the People's Grocer, as my 5th stock in the list. So I think what we should do is put this on a little table and then revisit it half year and maybe at the end of the year to see how we're faring with this. Can I just ask that whoever's unmuted there, let me just see if I can spot the person. I hear background noise. Oh, there.
Don't worry, I muted it. Yeah.
Okay, thank you very much. So with that, I'm going to throw open the floor for any questions for Vaughan. You're welcome to ask it in person or to type away in the chat. I'm going to go check the chat to see whether there are questions already. I see Donnie did ask, he said he couldn't see the slides nicely. If we could put it in slideshow view, and I said we'll just share the PDF of a couple of slides that we showed maybe with them afterwards. And then Willem says, can you please explain what you mean by overweight and underweight, Vaughan? So that's portfolio construction.
Great, yeah, thanks, Sorrel. And obviously with regard to the monitoring of this, as we said, overweight and underweight, let me show you the chart here, is remember we are managing a portfolio. So it might be slightly different from the listeners on this call, is that I would expect that some of the listeners of the call would like to pick stocks and are not at all concerned about the benchmark. Because we run a portfolio, we have to be concerned about the benchmark, which is why I'm going to come back to the comment that I made about Anglo. So what we talk about overweight is that if you look at the index in South Africa, and we can use the all share just as a simple one, is that roughly financials are about 25% of the index. So you add them up, Absa, all the insurers, etc., they form 25% of the index, or 1/4 of the index. If you are running a portfolio like we are, you have to benchmark yourself against the index to see whether you're adding alpha. Now, alpha means when you're beating the index or not. So what we're saying here is that we're overweight financials, which means we expect them to go up more than the index. So therefore, that's how we derive alpha. And that's where we're always caring about the benchmark. This is why it's important to highlight, because ours is the portfolio context. Remember what I said about Anglo, which Sorrel said he's scared of the miners. We are equally scared about the miners. However, we are not ready to move and reposition the portfolio to be very negative against them yet, because as we've seen, the momentum is incredibly strong. So we are trying to time our exit and our entry from those particular issues, which in itself is quite a task, as you can well imagine. So if we were to run this in a few months' time, there might be some changes to our top 5, because remember, we're using in the context of a portfolio. So at the moment, Anglo's done very well for us. We're holding on to it, but it doesn't change the fact we're worried about the China reopening. I hope that answers the question.
Yeah, I think it does. It's simply over and under versus what's being held in the index that you're tracking as a benchmark.
Exactly.
I see Donnie's got a question here. He says, have we got any views on Murray and Roberts? I see the share price took a serious knock, but I did not follow the reasons for this. I would have thought that their order book will be healthy with a momentum in commodities.
So two quick comments. I'm going to make a quick comment, and we don't follow it closely enough because fundamentally, remember, we have got a risk-adjusted portfolio. So those construction stocks, in our mind, are a very dangerous place to be. Again, it's volatility is a problem, and the underlying economic support for construction in South Africa is very, very weak. You have got what we call our business forums, probably what most people would call the mafia, who are simply hampering the ability of our construction companies to generate returns. And obviously there is a dearth, very low investment in the country. So that stops it. The problem with Murray and Roberts, if my memory serves me correctly, is they were trying to unload an Australian business, which they couldn't. And obviously the debt comes back to South Africa, so that caused them to go. So on Murray and Roberts, we don't have an opinion. We just don't like the sector.
Right, thanks, Vaughan. I see Wessels asking, I might have missed it, but I didn't hear any predictions on what effect load shedding might have on share prices in the different sectors for 23 and beyond. I suspect you're talking only about load shedding and not a complete shutdown. Wessel, as I think a complete shutdown might cause big problems for us in a full-scale panic. Although I think when the electricity goes off, the markets will go off as well, and by the time they return, we've seen it in the past where markets were forced into closure with COVID, that the initial drop is wiped out and things just return to normal in a pretty quick fashion. Vaughan, any sectors particularly that'll be hit hard by the continued load shedding?
So broadly speaking, as we said, we like banks because it's pretty much the only listed sector. Remember, if you can get private equity and somebody's loaning money to someone to actually put solar on, that would be fantastic. But remember, we are limited to the listed market, which is banks, because people are borrowing money there. But across the board, pretty much every sector, their costs go up. So if you look at the mining sector as a particular example, roughly 15% of their costs are electricity. They maintain that if they have to go into generators, etc., it's around about 4 times the cost. Most companies are saying that generators are 4 times the cost of electricity from Eskom. I'm quite skeptical. I think it's closer to 8 to 10 times. So most companies start with the miners, 15% of costs. You're suddenly growing at up to maybe 20% of costs. And remember, we've just had a massive increase for Eskom as well. So nobody's margins are going to be safe in this kind of environment.
Yeah, I see Derek has got a question, and he's saying the US is anticipating a world recession. How will that impact our market? I think they're busy massaging it, and it'll be everything is being massaged to secure a soft landing. We've seen interest in Europe and so on picking up as well. Once the rates stop, I think the recession fears will diminish, and even though some countries might slip into a recession, I don't think it'll last a long time. Your view, Vaughan?
So the real issue is exactly that. Which, if you look at the market prices, you're seeing the market is nervous about a US recession. As you can see, sort of US share prices have recovered, but they're still weak. And yet, just to give you an example, China, Naspers, our favorite stock, is up 80% since the beginning of November. So the market is trying to distinguish between a China reopening and, let's say, an ex-China recession. The problem is typically when you have weak global growth, it's not great for commodities. So it'll be interesting to see exactly which one of those drivers wins.
Okay, great. Willem says, Sarel, a while back you were bullish on MTN. The forecast was for it to go to around $220. You mentioned them again. What do you think at this stage? Where will it go to? I'll be blunt, Willem. I'm still a big bull on MTN. It dropped down to about 126 the other day when the news came out about Ghana. Ghana was only about 4% of MTN's market cap. We anticipate them to negotiate the fine that they got from the taxman. They'll negotiate it down, they'll settle it, and we'll move on. I think the first stop for the stock is still around $160. and long term, I still believe it's a 200 rand stock. So that's just my opinion. Fritz asking Vaughan, what mainly drives Anglo's performance? Is it gold or platinum demand?
So simply speaking, Anglo American is about quarter iron ore, it's about quarter platinum, and then it's got a whole bunch of small metals, copper, nickel, etc. So really what you're looking for is you're looking to drive iron ore and platinum. Just to give you an example, that's why we sold out of Billiton late last year, because half of Billiton's earnings are iron ore and a quarter is coal. Now, if you've got a very bullish view on those two, that's what's going to drive it. We are opposite. So we sold out of Billiton, and we're still holding Anglo for now.
See, Becky is asking any thoughts on SPAR and any further impact that the recent news can have on the share price. Becky, that we saw news this morning that the chairman and CEO is stepping down at the end of January. I don't think we're sitting with a situation where we have another Steinhoff on our hands. So I think that's also been discounted in the price, and I think I don't anticipate SPAR dropping much further. Willem saying, how do you review or estimate the FX risk for stocks like Renegen? Renegen, I've been getting a lot of questions about Renegen now, and the gas plant that they've got up and running in Virginia. We know that government has declared that a strategic integrated project, which is great. And I think there are prospects for great growth, but I mean, they're just starting out with production and storage and so on. So, yeah, maybe a longer term punt, but definitely very hard to predict at this stage. Meant by a soft, Chris is saying, what's meant by a soft landing? It's exactly that, where they're using interest rates at the moment to curb the inflation. And once they start seeing that the impact of the raised interest rates are such that the economy is slowing down at too rapid a pace, they'll start cutting or raising rates in smaller increments, so as to smooth out that landing that we're seeing. And then obviously when they see that things go too negative and we're heading for a deeper recession, they'll be very aggressive at lowering rates again to try and stimulate. So that's pretty much what we mean by a soft landing, Chris, if that answers your question. Any further questions? All right, I think let's try one quick poll before we close. I'm just loading these polls quickly. So the first one that I want to ask you is, where would you see the Rand at year's end? I'm going to launch it, and then you can pick one and then see what results come up. Right, if everybody can see that. I said $15, 16, 17, 18, or 19. Let's see where you think the Rand will be. You just click on the selection that you want and then say submit. Has everybody had a chance? Yeah, I see 7% of us say $19. 23% say 18, 26 say 17, and the majority of us think around 16 Rand. So the Rand may strengthen slightly if we look at where the bulk of our opinions are on that one. Let's try another.
Sean, I can't see anything.
Sean, you can't see the results of the poll, or?
No, I haven't seen the poll either.
No, you haven't seen the poll either. Okay. I'm sorry about that. I can't say why, because I've had quite a couple of responses. It may be
he must open his chat.
Okay. Thanks, James. If you open the chat, you'll see the response there. All right, let's go to the next one. Let's go to, no, I don't want to go to that one. What do you guys think the bourse will do over the course of 2023? Will it be down 10%, up 10%, or will it be flat? See, we got a couple of very mild bulls here. Looks like up 5%. 45% of people saying up 5%. Okay, so we're bullish, but not overly bullish. Okay, that was kind of to be expected. And now let's just, for fun's sake, pick a stock out of a list. This is quite a list that I've got here. I've got FirstRand, Sasol, Renogen, MTN, Shoprite, Absa, Woolies, Discovery, and Santam, just to throw into insurers there. So if you had to pick a stock, you know which one I'm picking. See you fire away. You had to pick a stock for 2023. I can see the live responses and how they're changing as you guys are voting. It's quite interesting. Most people don't like my pick of FirstRand at 3%. 26% agree with that Sasol can make gains this year. 10% will take a punt on Renogen. 19% will take a punt on MTN. 19% on Shoprite. 6% follow Vaughan in Absa. 6% say they will buy Woolies, and 12% say they'll buy Discovery, with not a single person wanting to buy Santam. So interesting result there, guys. So by the look of it, the consensus view of this forum is that Sasol, MTN, and Shoprite should definitely get a look at your portfolio. Discovery is a firm favorite there, 12%, along with Renogen. And Vaughan and myself's pick of the banks. Looks like it's sucking the hunted. So yeah, guys, thank you very much. That was nice participation there. I think if there are no further questions, then I'm going to close it and invite you. Our next chat we anticipate would be on funds again. I'm going to talk about funds next week, unit trust funds specifically, and the application of that. We'll give a recap on some of the performances of those funds. And late next week, we're expecting Sasol's results. So the week after, we would probably have Vaughan back to chat to us and give us his insights into the Sasol results, which are due end of next week. Thank you very much for your time. It was fun chatting to you today. And remember, if you have any questions, please don't hesitate to mail us at wealth@psg.co.za or give us a call at 011-996-5200. I'll also post those numbers in the chat for you. Let's see, 011-996-5200 or wealth@psg.co.za. Thanks very much for your time. Thank you, Vaughan, for your insight.
Cool.
Have a nice day.
Cheers,
Cheers,
everyone.
everybody. Bye-bye.
Thanks a lot.
Thanks, bye.
Bye.
Thanks
Bye.
very much.